Just before we push record here, Fannie has released their third quarter results, and I just wanted to note.
I think you have to adapt to what the market is telling you. And I've done things in the past in the residential real estate market that worked, and then they didn't work anymore, and it sucked, and it was painful, and I had to pivot and learn some hard lessons.
Episode 18 of Market Moves with Mark and Jeff. Jeff, excited to be here with you yet again for an episode. These are becoming a little bit fun as we get used to the format and whatnot, and excited to talk about today's topic.
Boy, yeah, absolutely, Mark. 18 is a bit of a milestone. It feels like we are having a good time, and as I've talked to some people about, just the podcast in general, it's the thing that keeps coming up is it's just fun to do. I mean, it's fun to analyze. It's forcing us to be a little bit more invested in what's going on around us and have something to be discussing here. But it's been a good experience for sure. In fact, I was just on a podcast that reached a much higher milestone than our humble 18th episode here. Dustin Harris was kind enough to invite me onto his podcast. We've referenced him in the past. He had Jim Amron, who we had on recently, talking about artificial intelligence on his podcast previously. He had me on talking about state appraisal board issues and how to stay out of trouble as much as you can as an appraiser. But he's just cleared the 1,000 episode milestone in his experience. So shout out to Dustin. Does a great job, and it was a lot of fun to be on there. I think that one will be dropping here pretty quick. So we'll see how much I embarrassed myself there.
Yeah, Jeff, with 1,000 episodes in, I wouldn't think that you could tank the podcast there, but you never know. So excited to see that when it comes out.
Yeah, absolutely. Well, with that, there was a big announcement, at least from our perspective, and I've actually been reading some perspectives from appraisers and from lenders and other market participants. FHFA, who oversees the Fannie Mae and Freddie Macs of the world, Fannie Mae, Freddie Mac are in conservatorship, kind of overseen by FHFA. They just came out recently, Mark, and made an announcement that they are expanding their appraisal waiver program to allow for a non-traditional appraisal, in many cases no appraisal at all, on loans that used to be at 80% LTV or loan-to-value ratios. It's jumped up to, and in fact, I think you're sharing this here on the screen now, but jumped up to as high as 97%, went from 80 to 90%. With no inspection at all, with an inspection-based waiver, meaning somebody goes in and looks at the property. It's not an appraiser and not an appraisal that's being done on it. They're allowing LTVs on those of up to 97%. What were your thoughts when you saw that come out?
Boy, I think more important than my thoughts might be the community's thoughts all the way around. Man, I got a lot of text message. A lot of frustration from the appraiser community. I think the context surrounding, like context of time surrounding when this announcement comes out, comes at a really difficult time, because this undoubtedly means less appraisal volume as a percentage of total loans as we go forward, and that is sort of kicking appraisers when they are about as down as they've been in the last 3-4 decades. It's been a really awful run for us. And in here we have another piece of news that is saying that the supply of appraisals is going to be shrinking. And this feeds a long-standing narrative that the amount of appraisal work out there for appraisers to handle is dwindling. So I think that certainly a lot of the frustration that I'm seeing is fed in some part by that, but I think it's also fed in part by those that really care about the health of the housing market, and this is the largest asset class in the world, and so the good health of the housing market, generally speaking, means the good health of the American economy, and to that extent, the world economy. And so I think it is really important that we keep a healthy and sound market here, which is the Fannie and Freddie's charges there are to strive towards that. So Just a lot of thoughts because this is offering alternatives to appraisals or skipping the appraisal most often on a larger group of loans. And certainly on higher loan to value loans, which are often viewed as the riskiest of the bunch. So, yeah, it's a lot to take in. I think that I've got a lot of maybe contrasting opinions. I can sort of straw man different sides of this and take the very unpopular opinion of possibly straw manning the FHFA's position one way or another. I think that the real trouble here is, Jeff, that we just don't have the data that they're using to inform their decisions one way or another. And so I think that makes it really difficult for us.
You bet. It certainly does. And I think that's really what it comes down to is, we're observing what their policy is because they just made it public and announced it. We don't have all of the insight to the back end detail. But, one of the things that I, or some positive feedback I've heard from a few of the most recent podcast episodes, Mark, were people just saying, hey, these discussions that we're having where we're looking at the facts, as they are and trying to understand them from multiple perspectives, it seems to be well received or positively received. And so I'm interested to see, kind of what, you and maybe others are thinking or saying, one way or the other. I'm an appraiser, you're an appraiser. At the end of the day, we would like to have appraisals to be doing, that's part of what's done. But I think to look at this from an intellectually honest perspective, what really is at the heart of the decision here and what may or may not be the impact, long term. I've had some thoughts, as they pertain to the macroeconomic environment and the environment for, residential real estate, over a broader time horizon, which I think we'll get into here. But I think worth noting on the outset that there are multiple perspectives, and I've seen, some. In fact, I think you shared an article with me from a lender, or at least somebody commenting from a lending perspective, that's saying, "Hey, this is great. I don't have to, I save some money on the appraisal fee potentially, and I don't have that potential hurdle in the process." So interesting that there are multiple perspectives on, is this good or bad? But I think that there are some realities that are implied here, whether you view them as good or bad.
Jeff, this in us preparing for the show, just kind of talking and finding ourselves maybe a little bit. I think not a lot, but a little bit on either sides of this issue. That is rare for us, and I think it'll be interesting to sort of vet out here one way or another. Jeff, I think the first point that I want to bring up is in this announcement here, and I know the text is a little small to see, but just to read the justification for the appraisal waivers going from 80 to 90%. FHFA says the policy builds on the long-running success of appraisal waivers by allowing more borrowers, particularly first-time and low to moderate income borrowers, to benefit from the cost savings and reduce closing times. As an aside, that reduced closing times, speed is critical. I think in every industry, and it is a core tenet of the business you and I launched together. Even if we don't hear often that speed is a desire, an increase in speed, it is a fundamental truth in every business, in every industry. In today's modern age, speed, artificial intelligence represents a lot of work being happening very quickly, often without historically required human labor. And so appraisers need to be fast in serving parts of the community or the market that they serve, or that's out there. So I think that's a really critical point. And we've talked a little about like appraisal management companies. Boy, is that need surrounded by speed, and in mortgage appraisal generally, speed is a really, really important component. I think the challenge of appraisers is how do I improve upon speed while maintaining or lifting quality? And there's the old adage of you can have it cheap, you can have it good, and you can have it fast. Pick two of the three. You can't do all three. And Jeff, I know you've heard me say a million times over. Forgive me for this diatribe, but blue oceans, blue ocean markets are ones that figure out how to do all three of those at once. And certainly something you and I have challenged our company to do. So reduce closing times. The market wants that. Borrowers expect it. And I think we serve borrowers, the end user of the mortgage process, better by speed. So that's first. But I think that they're defining the long-running success of appraisal waivers in that they are allowing borrowers, particularly first-time and low to moderate income borrowers, to benefit from cost savings. And it's a really interesting angle to highlight from FHFA in my mind. I would even wonder if this is truly how they would define success in these appraisal waivers. I can't imagine saving $400 or $500 when someone's buying a $200,000 property, $100,000 property, whatever it is. I mean, in the grand scheme, we've all bought houses. Certainly, you were sort of cash poor in that moment, no matter your financial standing. It's a difficult time, but so I get that to a very small degree, but it seems to me that FHFA would not be making these decisions if it was increasing their risk, if data was telling them that they are increasing their risk. And waivers I think the intuitive response was, hey, you are increasing your risk for bad loans tremendously by doing this. I don't think an expansion of this policy it doesn't lead me to believe that they are seeing more bad loans from appraisal waivers and therefore expanding the policy to create more bad loans or acquire more bad loans. So I would assume that they are seeing that this is that they are not increasing their risk by expanding or by using appraisal waivers in certain settings. So I'll set the table there and have you respond or provide some insights.
Yeah, you bet. So, it's interesting. I think you're right. The only logical conclusion here is that they're not making this decision in the face of their internal data that would be saying, hey, we're losing money on these things, but we're going to do it anyway for the sake of saving a borrower, whatever the appraisal fee is. And as you were talking, Mark, I mean, the thought did come to mind too. This isn't a cost savings for Fannie Mae, Freddie Mac, or FHFA. These are, these costs are borne by the borrower, and then they're saying, hey, we're saving the borrower funds. On what I'm seeing on these lower LTV loans, it's pretty common to see some concessions where you've got the seller making concessions to help cover closing costs, which cover things like appraisal, and so in some cases, not every case, depending on how the deal's negotiated, the borrower may or may not, actually be footing the bill for, the appraisal and other associated costs there. Somebody is at the end of the day. And I can certainly understand the perspective of reducing unnecessary fees to the extent that they're unnecessary. As you were laying the groundwork here, this idea of risk mitigation is an interesting one. And I can't help but kind of zoom out a little bit in terms of our perspective, just for a minute in this discussion, because I think that the logical discussion or the conclusion, like you said, is they're probably making this decision based on data internally that says, yeah, we're not increasing our risk, we're not losing money where we have appraisal waivers or inspection-based waivers that are part of the lending portfolio. I think it's just worth noting that, I don't recall value like residential values decreasing since probably 2011, 2012, somewhere in that time frame. In terms of the risk as it's associated with the collateral, we've been in an escalating value cycle for the better part of a decade and a half. And so I'm not surprised to hear that they're not losing money or that the risk is relatively low, because whenever a loan has been made in the last, call it 14 or 15 years, the value of the property almost universally has gone up over that period of time. I do think that the risk analysis and portfolio might change, if we get to a place of residential values, flatlining, which they've been more stable, but if they start going down, this risk analysis becomes, much more critical. But I think at the heart of the discussion here is the appraisal a better indicator of the value of the collateral at that point in time than what the GSEs are using as the alternatives to that appraisal? And but what are your thoughts there? Do you think that's a logical conclusion based on their actions here?
Yeah, sadly I do, and it's hard to put into words how I feel about this, because there are conflicting feelings, of course, but one of them is I don't want I like very much mean that I don't want a reduced amount of appraisals available for appraisers to complete. That is the last thing that I want. But I do live within an acknowledgement that as data is becoming better, that there are certain instances where data that someone would have on file making an underwriting decision is sufficient to calculate a low risk level for a loan. I think that is even an acknowledgement of a higher LTV in some cases. It just depends, right? And would I want the appraisal in our company? Would I want to be doing the appraisal on a track home with 400 sales in the last 2 months that are all very similar? 100%. That's my favorite kind of appraisal. But I also acknowledge that that data has improved to a point that sometimes that may not be necessary. And so, I live, I think, just internally with an acknowledgement that sometimes the data is probably pretty good that the Fannie and Freddie and others have in making a lending decision without me going out to the property. I wish that weren't the case, but on some level, it would be anti-progress for me to not want that to be the case, right? We want the end result is to serve the consumer the best, right? And so if data is good enough to move quickly in certain instances, I think that is a real win for the ultimate consumer.
Yeah, I think that's right, Mark. And like we're in a political season. I'm not endorsing political candidates, but I endorse appraisers. I mean, I want appraisers to be successful and in a good and healthy place, and it has been hard. So, from that perspective, the thought of appraisal volume potentially going down is kind of hard to swallow. But on the other hand, I mean, as I want to look at this objectively, and two, I mean, part of our job as appraisers is reading a market. Like, what's the market doing, and what are the market forces that are changing? Maybe a quick example that comes to mind is pre-COVID. In markets, I would see where pools would make a contribution to value, but it wasn't at the full replacement cost. You get COVID, you get cost run-ups, you get delays, you get a lot of people wanting to have outdoor spaces because other public spaces are closed down. And the contributory value of those pools really changed. It went up to near or matching replacement cost in many times, because if you didn't have one, it was going to cost more. It's going to take you several years to get it in. Our neighbor across the street spent like 2.5 years getting a pool put in their backyard because of all of the dynamics of pandemic at the time. I see that as analogous a little bit to us as appraisers assessing the market for the valuation services that we provide. You touched on the need for speed. I think the need is for speed and quality, and it's facilitated with the technology that is becoming available. It doesn't make it easy, and change is never easy. But I think that the market and one of the biggest users for valuation services is changing. They're adapting to what they need, and whether I like it or not, whether I want to judge it as good or bad, I think at a minimum acknowledging that here's what they're doing, here's what they're saying, and it being that they're a very heavy user of appraisal services, even if those go down some, we do know that they need some base level of appraisals fed into their collateral underwriter type programs to feed the machine, so to speak, but that they're making further allowances that on net are going to reduce the number of appraisals in the system is an acknowledgement I think that we ought to make, and frankly, as an acknowledgement that some that in the lending process don't view as a bad thing either necessarily. Now, if value starts to go down and the market changes materially, I think that there might be a shift in this perspective and this risk tolerance. But I think in the moment there's a reality that if I'm a loan officer putting together a loan and I don't have to get an appraisal, many times they choose not to get the appraisal, and it's, they view that as a net benefit, and the ultimate buyers of these loans are kind of expanding the ability to do that in this moment.
Absolutely, Jeff. And I want to pull up here because there's a couple of points made in this announcement or message from the Appraisal Institute and current president, Sandy Adamatis, that is in response to this FHA thing. And I think the Appraisal Institute and Sandy has done a really good job here of representing, to some degree. I've seen many comments that they would like it a little more intense. But I think it does represent the appraiser's frustration and concern about the housing market. Remember, appraisers' job and role within this within the marketplace is to uphold public trust and really to protect from a collateral risk perspective, the housing market, right? And so I think this captures very much the concern with an expansion of skipping the appraisal, and so great job on that. But the fourth paragraph down here, I'm sure it's too small, or we have a lot of listeners not watching here. But in the middle of I think it's the fourth paragraph here, it talks that strangely, approximately 40% of purchase loans between 76 and 80% loan to value received an appraisal waiver in July of 2024, triple the amount of the nearest LTV risk category of 71 to 75%. So to summarize, the claim here is that loan to value, as it has gotten closer to 80%, waivers are used more, 40%, where, I don't know what a third of, 12% or so in the loan to value ratio of 76 to 80%, right? And so there's why, right? I think it's a great question and represents a concern in my mind of, you just have less margin for error, at least from the collateral risk side. Do you have less margin for error on that unique loan due to the borrower's credit profile? We won't know that. We don't ever know that. I assume that is part of the decision that they're making. May not be. Please correct me in the comments if I'm wrong there. But I think there's a lot of consideration that the GSEs have, or FHFA have, in making these decisions on when to use an appraisal waiver. Like, when's the last time they had an appraisal on this property, right? We don't know that. We likely wouldn't know that. But that's an important component, or maybe an important component in their risk decision. But when an appraisal waiver is being used, what are all the criteria to ensure the soundness and the safety of the universe of loans that they're acquiring and repackaging? And I don't know the answer to that, but I if they are seeing success in appraisal waivers from a lower risk of defaults when appraisal waivers are offered, my guess would be that they would be invoking the appraisal waiver on a high LTV loan when they know the rest of the picture is fairly safe for one reason or another, right? And that's a lot of assumptions for me. I don't know that, but I do think it's a fairly safe assumption to make, given the expansion of the progress. And, Fannie just released their Q3 results. We can review those in a second. Since you're here, Mr. and Mrs. Viewer, might as well digest that. So we'll show that in a second. But yeah, Jeff, so the judicious use of waivers, or not judicious, how do you feel about that one way or another?
Yeah, such an interesting question, Mark, and it's certainly loaded in terms of the response. I do see that at the end of the day, I mean, they're making the decisions that they're going to make, and we can love them, we can hate them, you can rail about them or whatever, but given that I'm not in a position to make their policy for them, I think trying to understand where they're coming from, is valuable. Complaining about it, I don't think does a whole lot. I think there are, a couple of things that come to mind. One, if we enter a declining residential value environment where across the country we have a broad correction in pricing, and we've talked about this a little bit in a couple of the recent pods, where if interest rates give, which helps with the housing affordability, then home prices probably stay closer to where they're at. interest rates are going the opposite direction. And in fact, you were observing that they're continuing to go up. They're 7.25 or somewhere in that neighborhood when we looked this morning. A far cry from trying to get under 6, just not very long ago. We talked last week about policy and both presidential candidates concerned about housing affordability and providing affordable housing for people because that is an issue in the moment. I think where that relates to this policy with appraisal waivers is if we don't think that interest rates are going to come down and that then leads to a softening or a correction in home pricing at some point, which to me increasingly is seeming like maybe the more likely scenario. If asset values start to decrease and I've made a 97% LTV loan and all of a sudden homes in that neighborhood are now listed for less than what the we valued, what the GSEs might have valued that property at in making the loan, they're going to care, I think, a little bit more about the value of that asset and up to the minute information, not necessarily historic stuff that was pumped into their system because the home was appraised 3 years ago and they knew what kind of condition it was in at that point and that sort of a thing. So I'm just making an allowance for, I think that markets are dynamic and are going to change. And the way that this decision looks today, will look different down the road. And if we're in a different environment, I think it may get pulled back, it may be amended, it may be, full steam ahead, from their perspective, but we're not in a static market. And increasingly, I kind of sense that we're going to have, something give that addresses housing affordability, and it may be the pricing of the homes.
Yeah, it makes sense. I think restating what you said there is that, how does all of this work when prices are going down? And we haven't seen that environment. And if the GSEs were basing their expanding of these appraisal skipping policies essentially based on appreciation data sets, that may get them into trouble. And it's notable to me, and I think in my subconscious a little bit. I've seen I travel to these appraisal conferences or foundation meetings, appraisal institute meetings, whatever they are. I make my way around as lots of folks do, and so I hear Danny Wiley from Freddie Mac, I hear Lyle Radke from Fannie Mae speaking often. And it's often a very consistent message from each of those, and I find the message most often is reminding everyone we are a risk management company. That is what our goal is to manage risk and not get in trouble on these loans. And so, this has been hammered into my ears so many times, and it resonates, I guess. Of course they are. That's kind of what they're doing. And so all of the policies and expansion or contraction or whatever are in the context of their primary goal of safety and soundness and risk management. And so I guess, to some degree, I would assume that they are considering that we might be in a declining market sooner rather than later. And how does that play? I think it would be a good question for them. And Jeff, we try to get these episodes out weekly and talk about current topics. And it would have been great to get a representative from one of the GSEs on here, and we'd like to do that. We will. They can answer some of these questions that we have, or maybe they can. At least we can ask them. So we'll do that on future episodes, but hard to do that when it's just hot off the press like this.
Yeah, you bet. Yeah, the more behind the scenes that you can get, and I think the problem that we have, and this isn't just on this particular topic, but it's just so common with an abundance of information out there to try to connect dots with a limited, perspective or scope. And one of the things I found is that talking, with representatives from Fannie Mae or Freddie Mac is usually there's a more coherent perspective and rationale behind some of the things that they do than what you maybe assume initially. And that doesn't mean that you necessarily agree with or that what they're doing is always going to work out well. They've run into financial problems in the past in this risk mitigation business that they're in. They're in conservatorship for a reason, because it hasn't always been rosy. And so it remains to be seen how it plays out, Mark, when and that's that's the way it is in any market, and trying to gauge what risk is, what are values doing, how should we be participating in a market. There are always winners and losers in that process. You learn as you go, and you try to get better. I think they've done that. I think as appraisers, we try to do that. Any market participants are competing for, whatever share of the market they can, that they can bring in. And I think it's probably not a lot different here. You were sharing some information that sounded like Fannie Mae isn't totally losing as far as at least being a profitable venture in the moment. What perspective do you have there?
Yeah, so just before we push record here, Fannie has released their third quarter results, and I just wanted to note that $4 billion in net income for Q3 of 2024. So doing quite well there. Net worth, I mean, all of these are good. You see a little tick in serious delinquencies, which I think are defined as 90 days of no payment. So an uptick, I wouldn't. That doesn't surprise me, given the difficulties in the economy, at least in certain segments that we see. And where is that $4 billion for the quarter that I circled? You can see how it is in the context of the last year and a quarter. It's the second lowest, but doing okay. I think that is speaking to the stillness in the marketplace. But I just conferred with our friend ChatGPT that Amarin was helping us with, and just pulled these are quarterly net incomes since January of 2012. Hard to read, I'm sure, but they are much lower now than they have been, but every quarter they are pulling generally between $3 and $7 billion of net income. And this last quarter stands almost right in the middle of how they've been doing, maybe a little on the lower end of the median here. So it's been a good year for them, and they don't seem to be impacting profitability, at least to the point of some sort of a red. So they're a long ways away from that, Jeff.
$3 to $6 or $7 billion in quarterly profit doesn't sound like a bad place to be, frankly, Mark.
Yeah.
I could live on that, I suspect.
Yeah, I think that's right, Jeff. So I think my advice, which admittedly will not land very well on appraisers' ears, at least I'll just share how I tend to look at these things, is, for 2.5 decades that I've been in this, the sky is falling. And to some degree, there is truth in that, right? The demand for mortgage appraisal work is going to shrink as a percentage of population in the United States, or housing supply. That is going to happen. Some good news is that you've got housing growth, inventory or supply growth. You have population growth, although that seems to be changing a little bit. But I think for the foreseeable future, population growth, those things are going to increase appraisal demand. So those have a building effect. And then a tearing down effect are initiatives like this, where there are growing instances where users of our services no longer need our services. This has been true for 2.5 decades. It's kind of climactic moments like this that really make you feel frustrated and down. They often come and at the worst times, as this one has. But most of us listening to this have built really good careers over the last 2.5 decades, despite this declining as a percentage of total population use of our appraisal services. And I think we're a long ways away from that declining to a significant amount. We have lost a lot of appraisers in the marketplace over the last 10 plus years. That means more appraisals for the appraisers that do exist. It's very hard to get in this industry, so people are there. And where I find comfort is not trying to, I guess, just acknowledging and being comfortable with the fact, Jeff, that appraisal volumes as a percentage of people are going to go down. And to the extent that is helpful to the consumer, I want to be for it. I don't know if this initiative and waivers fully are good for the consumer. I think many on the other side are saying they're not. I don't have all the data to make that decision. I do have a little bit of an assumption of rational thinking from FHFA in this case, that it could be good for the consumers. And so I want to be for things that are good for consumers. And I, as an appraiser and someone leading appraisers in my own company, I want us to strive hard to serve consumers better every day. So that's what we're trying to do and figure out where our place is. And would waivers be used as much? Certainly the inspection-based waivers, would they be used as much if we were able to turn around our product faster? I don't know. Maybe not. So just one way to think about this is a challenge to improve our services.
Yeah, and like I was saying, we're competing in a market, and just like, to your point there, Mark, that to the extent that we can provide what the market demands in terms of quality, in terms of speed, in terms of reliability, I think that there's a need. Now, the flip side of the point that you've been making is that you know both Fannie Mae and Freddie Mac have invested. I think they're 7 or 8 years into this redesign of the uniform appraisal data set. They need some base level of data flowing into their
Hmm.
systems to be able to offer these waivers in the first place. I don't think appraisals are going away, in a lending environment. And of course, there's a whole contingent of non-lending appraisal and valuation service that some make a great career on and around. It's the way that you get to work, the way that you interact with clients. There are differences and nuances there. But I think even in the mortgage lending space, there's a base level of appraisal work that needs to be done. I think that, as is true in any market, you have to adapt. You don't have to like it. I mean, you may want to continue to do things the way that you did them 30 years ago, and that are comfortable and that you're familiar with and that you're trained on how to do. Technology is disrupting all of us, and I don't necessarily love all of that, but I would rather adapt it and survive than, fight it and not. In fact, I was listening to I think it was a podcast or a summary of a book recently, and they were just summarizing a concept from Charles Darwin with evolution. And it struck a chord with me a little bit, in the context of this conversation, Mark. He said the observation in evolution was that it's not the smartest of the species that survives and is around long term. It's not the strongest of the species that survives and is around long term. It's the most adaptable. And that rings true to me in a market context, whether you're talking about the market for appraisal services or any other market in the world. I think you have to adapt to what the market is telling you. And I've done things in the past in the residential real estate market that worked, and then they didn't work anymore, and it sucked and it was painful, and I had to pivot and learn some hard lessons, in terms of investing in real estate and that sort of thing. But it just rung true to me that you have to adapt if you want to survive and be the one that is around in the long term. And that's not a comfortable place for most of us to be, but I think it's a reality, that we live with anyway.
Very, very well said, Jeff. And I don't have an AVM. I don't sell AVMs. They certainly have taken some amount of business I would have gotten otherwise, but they have generally been a positive on the industry, and I'm generally glad they're there to support that segment of the market that I'm not able to as it's modernized. The 2055 drive-by was another evolution that didn't survive, but was there, and maybe it's sort of rearing its head again in the form of these inspection-based waivers or just hybrid sort of products. But I totally agree. And adaptability, and I think to be adaptive, you've got to acknowledge the trends that are in where they're going. And if you can, if at least in my experience, if you can position yourself such that you're in favor of that, it's just easier for me to think adaptively and try and get there. And how can I be part of the solution that is being brought to the marketplace? So take that for what it is from me. I really appreciate your comments there, Jeff. And I'm still sort of evolving, I guess, on this topic in particular, because it is tough and it comes at an awful time. So we'll more to come here, I think, on this episode. And I think thinking optimistically, so demand for appraisals is getting smaller in some within some currents, right? That is for sure. I think we can be pretty optimistic that the immediate death to other industries right now that are obvious are artificial intelligence. The call center seems like one that is, boy, I would be worried if I was there. And it doesn't stop there. I mean, there are industries almost overnight that are in real trouble here, I think. And we aren't that, right? I think we have, at least you and I have concluded that artificial intelligence is not a threat on the appraiser in the immediate. And for that, I think we can be thankful. And it's because of the unique position that appraisers serve and the unique judgment that they bring that AI just can't do.
You bet. And there's been a lot of pain for developers, coders, that sort of a thing. AI can bring productivity, but it's having a more dramatic impact, I think, in some of those markets. I'm hearing of situations where people were competing for talent in Silicon Valley, and now it's, that's kind of been flipped in reverse, and you've got more talent that's available to, to do other things, but it's just not what it was, and we certainly aren't feeling this, that dramatic of effect, at this point. So, it's, maybe there's a silver lining. Maybe AI will take over for all of this, but if that's the case, then maybe none of us are immune from it either. I don't know.
There you go. Well, Jeff, as we are switching topics and reaching our last topic of the episode is, well, we've got the election coming up in 6 days now, I guess, or 4 days, 5 days, whatever. We're recording this on Thursday morning. I think everyone will be excited to have that behind us, no matter the result. There feels like an extra level of stillness. This ridiculous mortgage rate at 7.25%. It was 6.15 when Powell lowered rates by 50 basis points, a surprise on the downside. And the reaction has just been, to me, unimaginable, but I guess glutton for punishment. I should have seen it coming. What do you think?
Boy, I think they should go down. I think everybody I talk to would like rates to go down, and they're simply going the opposite direction. And it's been pretty quick too. That the rate has gone up. Which is, I think, leading to this slowness that you're talking about. In fact, I think we shared an article, or I saw one recently, that said the rate of existing home sales was at a 30-year low. I think was the lowest since 1995. That existing home sale levels were, where they are today. As you got to go back that far to see them again. And as you talked about earlier on, the U.S. population is not what it was in 1995, and we've got far more people in the country, and we're down to that level of transactions, at least, for existing homes. We did see just this morning, in fact, as we were talking, the PCE report came out, kind of in line with expectations. It was a 2.1%, increase. PCE is what the Fed's, it's always, put out there as the Fed's preferred gauge of inflation. Essentially in line with the expectations, down from 2.3% with the read last month. Setting up, the headlines I'm seeing is setting up an expectation that at the next meeting, the Fed's planning to cut rates again. Now, if them cutting rates is inversely related to the mortgage rate, then I wish they'd stop it, because, they cut the rates and the stupid rate went up, quite a bit. I expect that as they, if they do make a cut, that we'll see some relief, trickle through to on the mortgage side. But anything would be welcome at this point, because it's certainly gone the opposite direction that I think a lot of us were hoping and expecting.
We talked about Powell's rate cut before, and I think we got just about everything wrong. But the one thing that we didn't get wrong was that he likely would signal future but near-term further rate cuts, which would just paralyze the marketplace. And that has happened for sure. And I think that's a really big part. So when Powell speaks, I think it is next week, my hope is that we get a rate cut, and maybe we've got one more that the market would be expecting based on his comments. I wouldn't be surprised if he pulled away from that, given how 10-year Treasury has responded. But that might be good, just to get the dang next rate cut out of the way, and these folks that are waiting for that to happen to move. At least that's speaking from an appraiser that's looking for appraisals to do. So I think that's something to look forward to. Jeff and I listen to a couple of podcasts pretty regularly that were actually the informed the style of this one, at least, and it's All In and BG2. We can link those in show notes if people would like them. But All In, one of the participants, Chamath Palihapitiya, who I appreciate his economic perspectives. They're usually pretty macro and unique and well informed. But we have had a lot of wild stuff happening, including this mortgage rate pushing. We've had equities going higher, gold and Bitcoin rising, the dollar rising. Just all sorts of things that are happening out there. And his description was the market readjusting to an expected Trump win. And his thought was that was a lift on the economic outlook for the country. Don't know if it is one way or another, but the election, I think in that, what I think the takeaways from there could be is that just having certainty with the election may help us one way or another. And, Scott DiBiasio last week introduced a concept that I hadn't really considered, but the market generally is looking at both candidates as extremely inflationary in terms of stated policies. That is how you get elected these days, right? Is you spend, or promise spending to voters, and so both of those are inflationary. So I think the market may also be seeing damned if you do, damned if you don't. We're heading back towards inflation, so having some certainty there will help. Maybe it doesn't move rates, maybe it moves them higher, depending on who wins. I don't know.
Yeah, I'm glad you mentioned that, Mark, because on the one hand, you got the Fed with what they're expected to do and have been signaling that they may do, which is, a cutting. But I think that's part of what's informed my conclusion of I think we may be in for higher rates for longer. We're seeing, and part of the reason the Treasury's going up is you got to have buyers for the bills when they get put out to market, and there's been a softer response to those. I suspect that there is some concern about the financial stability or the economic well-being of the federal government. Its ability to continue to pay and to borrow with no end in sight seems to be the way forward, regardless of who wins the election. And if rates stay high, I think the only logical conclusion in my mind is that asset pricing is going to come down, residential real estate and others too. I think equities in the stock market and others, may be poised for a repricing if that's what plays out. And Scott's perspective last week was really insightful. I hadn't considered it, either, as you said, but if that's the reality, I think you can start to draw some conclusions about what may happen in these markets, and then, prepare yourself accordingly. But it's, we'll see how it plays out. It'll be interesting. There's no doubt about it.
Yeah, we talked a little bit about that in the Housing Bubble podcast a few back here, and I think if prices dropping are going to make people or drive people to action, they're going to have to be significant. 3-5% ain't going to cut it if that's where we're going to have to get, and if people have to move, if they've got to sell and those sorts of things. So it will be interesting to watch. Hey, Jeff, I'm would love to find, and we will be efforting to find, bad loan analysis on appraisal waiver issuances with GSEs. If anybody's got that information or sees it, please share it with us. We'll be happy to cover it on the next podcast. That certainly could change my perspective, Jeff, from where I were. But I think it was you that suggested that Lyle Radke from Fannie Mae had mentioned in a speech that they saw reduced instances of bad loans on appraisal waiver issuances.
Yeah, I've heard that for sure at one of these conferences you were talking about, Mark, and I don't have all of the detail around where, the context for him. Obviously, in the past, with this announcement that we've been talking about today, they were making those in a lower loan-to-value scenario, which you would assume is a lower risk scenario, in the first place. Typically, they're offering those when not only it's a low LTV, but they have good data otherwise around the property they're loaning against and the strength of the credit profile of the borrower. And so it doesn't totally surprise me, on the one hand. But yes, we'll see what additional data we can find and then bring to this podcast in the future to sift through it. I did note that quote that you had from the Appraisal Institute president Sandy Adamatis was citing the American Enterprise Institute, AEI data source, and they do a lot of tracking on that. So that'll be one good source for us to dig into a little bit deeper, I think. But it's all about the data. I mean, that's what appraisers live and die by, and maybe this podcast too, if our personalities don't kill it.
We will certainly strive to be more data and less opinion as we go forward. But yeah, well, episode 18, Jeff, that's a wrap. Thank you for this time for Jeff, me, and my plant. We'll see you next week.
Pleasure. Thanks, Mark.